Okay, day 9, and we're going to be talking about where to buy. Now, people that have budgets that are limited, which is most of us, one of the first questions is where should I buy? Should I buy in Timaru? Should I buy in Hawke's Bay? Should I buy down the road? Well, I want to challenge the assumption that where to buy is a location based question, and I would say that it's a numbers based question. So, deciding where to buy starts with understanding your borrowing power. So you can get a pre-qualification from a banker or a broker, so you can understand what you're working backwards from. So let's say your maximum borrowing power is $1 million. Now what we want to avoid if you want to build up a portfolio is maximizing out, like you don't want to max out your leverage. So you don't want to borrow up to 1 mil when you buy your first investment property or your next investment property. You want to go just below your means to free up borrowing power and to make it easier for you to buy again after this one. Because if we max out now, then borrowing again for another property might take years and years and years, and you'll lose interest. So what we've got to do is we've got to understand the numbers, the gross yield, net yield, cash on cash return. So the gross yield is just a simple equation, the annual rent over the total cost, and you can have a look below, we'll do some example calculations. The net yield is the profit, so take away, you got all of the income, all of the expenses, what's left over. Cash on cash return is based on what your cash or your equity investment is into the deal and what will return based on that cash component. Now, the equation that I want you to learn and to think about most is mortgage coverage. If you're interested in building up a big portfolio of properties, you have to understand the mortgage coverage equation and how it's evolving and how it impacts your borrowing. Now, it's just simply annual rent divided by your mortgage, and this is one of the key things that banks are looking at to help determine whether when you buy an investment property, the way you've got it structured and leveraged is going to be if you can keep borrowing based on that investment property or not. So what happens to most people is when they buy an investment property, owning that property the way that that is geared in terms of how much debt is on it prevents them from borrowing again. So a lot of people have 3 or 4 properties but they can't keep buying because their mortgage coverage equation is not strong enough for the banks to lend based on that position. So what is this in practice? Now most people have a mortgage coverage where the yield based on their debt on that property is relatively low. So an equation might be that they're getting $500 a week of rental income, they've got $800,000 of debt, they're getting a 3.25% mortgage coverage. Now what you want to think at is, and it might seem like an extreme scenario now, is $850 a week rent, $400K of mortgage attached to that, gets you the 11.5% mortgage coverage. Anything above that 10.5% range, then this structure here is actually going to allow you to borrow more money. This one, you can't. So how can we make our mortgage coverage position a bit better? We can put more cash into the deal, which not everyone has the ability to do, so you're not leveraging as much. Or you can focus more on yields. So that means buying properties probably more regionally based or more focusing more on renovations to improve the net profit at the end of the day. You really got to understand that yield impacts borrowing power and it impacts the ability of being able to keep borrowing. And so when you're deciding, oh, where am I going to buy? It's more of a question of where can I buy that's going to allow me to keep buying, keep getting me the returns that I need to feel secure with this property investing. No one should be saying to you, hey, buy in Christchurch, buy in Wellington, buy this, buy this. If somebody is specifically saying, hey, buy in this area, it's usually because they're selling something specific, maybe that they've got a commission tied to it. Once you know your borrowing power, once you understand that mortgage coverage, deciding where to buy should be a lot easier because you'll be able to say, okay, for example, in Auckland, I'm not going to get the yield that I need to build the portfolio I want unless you're flush with cash and you can help prevent your leverage getting too high. So most people, normal property investors, family investors trying to get established, probably going to have to look outside of Auckland, and they're going to really have to double down on their knowledge around yields and creating yields. So buying a new build, for example, and just relying on the automatic rent is not going to allow you to keep borrowing unless your income is really high and you're able to keep pouring cash into those deals. So mortgage coverage, it's a simple concept that might be new to you, but that is going to be the first thing you think about when you're thinking about where should I buy. Now we're going to have a look at what to buy next. Let us know questions in the comments.